Hi, my name is Seth Gleason. Today for my case study, I will be going over a job at East Coast Yacht Parts 2. I feel like this is a very good case study showing the relationship between two different, a bond and a stock, and seeing how much how much you should invest in each different stock or bond. So I am excited to go over this with you. Awesome. Now for some of the context. For this case study, we're basically comparing and understanding the relationship between the Bledsoe Large Company Stock Fund and the Bledsoe Bond Fund. The Bledsoe Large Company Stock Fund is a fund that invests primarily in large capitalization stocks of companies based in the United States. This fund is managed by Evan Bledsoe and has outperformed the market in 6 of the last 8 years. The 10-year annual expected return for this is 11.08%, and the standard deviation is 26.73% during these 10 years. The Bledsoe Bond Fund, this fund invests in long-term corporate bonds issued by U.S. domiciled companies. The fund is restricted to investments in bonds with an investment-grade credit rating. The 10-year annual return is 8.15%, and the standard deviation is 10.34%. And there is a 0.16 correlation between the two, and the risk-free rate is 2.76%. Before I start to answer questions 1 and 2, I really want to continue to emphasize the context of this case. I'll go ahead and read the case study. It says that you are discussing your 401k with Dan Irvin when he mentions that Sarah Brown, a representative from Bledsoe Financial Services, is visiting East Coast Yachts today. You decide that you should meet with Sarah, so Dan sets up an appointment for you later in the day. When you sit down with Sarah, she discusses the various investment options available in the company's 401k account. You mention to Sarah that you researched East Coast Yachts before you accepted your new job. You are confident in management's ability to lead the company. Analysis of the company has led to your belief that the company is growing and will achieve a greater market share in the future. You also feel you should support your employer. Given these considerations, along with the fact they were a conservative investor, you are leaning towards investing 100% of your 401k in East Coast Yachts. So the first question asks, considering the effects of diversification, how should Sarah respond to the suggestion that you invest 100% of your 401k accounts into East Coast Yacht stock? The effects of diversification are very simple. The principle is that spreading an investment across many assets will eliminate some of the risk. What it's basically saying is that it's bad to put all your investments into one area. So it would be a bad idea for you to put 100% of your stock into the East Coast Yachts because if East Coast Yachts plummets, then you lose all of your investment. This is a key reason why mutual funds are so important. You get to spread your investments over a wide array of different areas. The second question, after Sarah convinces you not to invest entirely into the East Coast Yacht stock, is it best to invest 100% into the bond fund? For similar reasons, because of diversification, it is not worth it to invest 100% of your stock into the bond fund. Again, if the bond fund crashes, then you will lose all of your investment. So that is why we like to, it is a good thing to invest in multiple different stocks, having some of your investments in the East Coast Yacht stock and then some of it in the bond fund, and that is what we will continue to learn about. Question 3 talks about how using the returns for the Bledsoe Large Stock Fund and the Bledsoe Bond Fund, we're supposed to graph the set of feasible portfolios. This is a very interesting question, and I built it up on Excel. So if we look here, we have our weight in bonds, which starts at 1 and goes down to 0. This in the Excel document, this document goes all the way down to where this would go down to 0, and the weight in stock would go up to 100 or 1. The expected return is we had to do some math to get that, but it's using these inputs. We were able to do some math and to find the data that will go into the expected return, and then the portfolio risk to the standard deviation, and then also the Sharpe ratio, which we'll get to later. But after doing the math, I was able to come up with a graph like this. This right here represents the Bledsoe Bond Fund when 100% of the investment is invested into the Bledsoe Bond Fund, and then over here is the Bledsoe Large Company Stock Fund, where when 100% of the investment is invested in that. So as we see, this is a standard opportunity set curve. It just goes like this. This is very typical. Most of the data is surrounded in this area, with becoming more and more sparse as we go out this way. But yeah, this is opportunity set of feasible portfolios for this example. Question 4 talks about how after examining the opportunity set, you notice that you can invest in a portfolio consisting of the bond fund, and the large cap stock fund that will have exactly the same standard deviation as the bond fund. What are the portfolio weights and expected return of this portfolio? So again, this was I used this in Excel. Was able to put the expected return for the stock, which was, again, as I was saying earlier, is our 11.08%. And then we had expected return for the bond, which was 8.15%. Standard deviation for the bond and the stock are 26% and 10.34%. And then there's a 0.16 correlation. And using some math, some code that I coded in order to get the weight of the stock, use this equation, which just takes the data from these and computes the weight of the stock, which we see as 0.17. And then the weight in bond, that's just 1 minus the weight in stock, because the weight in the bond and the weight in stock have to add up to 1. So it adds up. And portfolio, again, kind of a very similar thing as this, but did some math to actually compute this number again. And then the portfolio expected return using math that you might not be able to see because of my camera, but it goes to 8.65%. Examining the opportunity set, you notice there's a portfolio that has the lowest standard deviation. This is the minimum variance portfolio. What are the portfolio weights, expected return, and standard deviation of this portfolio? And why is the minimum variance portfolio important? Yes, this is a very good question. So when we were gathering the data for this assignment, I incremented it by weights in stock of 0.01. This is why you see these dots right here. These are different, incremented by 0.01 in the weight in stock. So to find the minimum variance point, we need to find where the standard deviation is the lowest. And since this is the standard deviation right here, the point which is the lowest would be this point. And when looking through the Excel spreadsheet, we find that the portfolio with the standard deviation is at 10.07%. The expected return at this spot is 8.41%. And the minimum variance portfolio is very important. It really shows where the risk is lowest for the investment, so it can be very helpful to investors to know. Last question is, what are the portfolio weights, expected return, and standard deviation of the Sharpe ratio? Again, the Sharpe ratio, graphed it versus weight in stock, and then the Sharpe ratio. So the Sharpe optimal portfolio is one of the things you're looking for, and that is where that's where the maximum Sharpe ratio is. So that is right here, and this is when the weight in stock is 0.13. Expected return is 8.5% at this point. Portfolio standard deviation is 10.149%, and then the Sharpe ratio again is or at that point is 83.78%, or